The opening bell rang and U.S. markets took off. On Monday, the Dow Jones Industrial Average surged nearly 700 points, pulling both the S&P 500 and the Nasdaq up into deeply positive territory alongside it. This sweeping wave of green across the trading boards is a direct, real-time reflection of a massive influx of global investor confidence. Billions of dollars are being rapidly deployed back into the market. But for all the cheering on the trading floor, this trillion-dollar rally is surprisingly fragile. It is resting precariously on a highly sensitive balancing point. That balancing point is a single U.S. government document scheduled for release on Friday morning, the National Employment Report. The market is currently pricing in a perfect economic scenario based on what has already happened, leaving it completely exposed to whatever new reality is printed in that upcoming data. To understand why the market is running so hot right now, we have to look at the macroeconomic forces, starting with energy. Renewed diplomatic efforts in the Middle East have eased fears of supply disruptions, causing global crude oil prices to drop significantly. This flowchart traces how dropping crude oil prices filter down. Cheaper fuel lowers expenses for transportation fleets, reducing material costs at factories. When factories spend less, they don't raise shelf prices. This relieves broad inflation metrics, giving corporations and consumers critical breathing room. Economists call this macroeconomic relief. It is the psychological and financial boost that washes over investors when the data suggests the worst of a stubborn inflationary cycle is finally in the rearview mirror. So the current euphoria gripping Wall Street is effectively a collective sigh of relief. The baseline cost of doing business globally is getting cheaper. But while cheaper oil creates a stable foundation, it is the technology sector providing the explosive upward momentum. Recent corporate earnings reports have blown past expectations. Palantir's share price saw a massive jump after the software company posted surprisingly strong quarter-over-quarter growth. This success is closely tied to the massive build-out in artificial intelligence. Hardware infrastructure leaders like NVIDIA continue to post solid, uninterrupted gains as the demand for advanced computing power accelerates. That forward momentum is spilling over into consumer and logistics giants like Amazon, projecting a unified front of corporate resilience across multiple sectors. Because these technology megacaps carry so much mathematical weight in major indices, their isolated successes possess enough gravity to pull the entire Nasdaq sharply upward. A 700-point market surge requires a specific set of circumstances. Right now, Wall Street is experiencing a rare collision, a macro-level drop in operational costs, matching up perfectly with a micro-level explosion in corporate profitability. Yet, for all the green on the board today, the newly minted wealth from this rally is far from secure. The market is about to enter an anxious waiting period. Investors are sweating over two immediate hurdles: a final slate of major corporate earnings calls, and, most crucially, Friday's highly anticipated release of U.S. employment data. That jobs data matters because it is directly read by the Federal Reserve. Their subsequent decisions on where to set interest rates dictate the cost of borrowing money, acting as the underlying gravity for all stock prices. This visual scale illustrates the paradox of the current labor market. If job growth is too strong, the Fed will refuse to cut interest rates, which hurts stock valuations. But if job growth is too weak, it signals an economic recession is underway. Investors are praying the numbers land right in the middle, the Goldilocks zone. They need data showing an economy cooling just enough to justify the Fed cutting rates, without collapsing. Because the United States operates the world's largest economy, the Fed's ultimate reaction to Friday's numbers will dictate the flow of global capital and set the tone for economic confidence worldwide. Until that document drops, the entire financial system remains suspended in anticipation. It is a stark reminder that market health relies far less on the gains of yesterday and almost entirely on what happens next.